Good morning. This is 1.5 greybeards, as you can see. Without further ado, let's go straight into what happened last week and how it might affect our portfolio. Andy, what do you think were the most salient facts that happened last week?
Yeah, I mean, as we mentioned at our prior episode, the CPI was the number that everyone cared most about. It came in right on expectations, but digging a little deeper, it showed, as expected, goods inflation continued to be weak and services inflation being fairly strong.
I would agree. I think that the market missed the fact that services inflation continues unabated, and that is not what the Fed wants to see, not what the Fed has told us they want to see. And therefore, I think the odds are very high that they continue with the tightening. I think it's going to be a 25 basis point tightening in Feb 1 rather than a 50. The market rallied slightly on it because everyone was badly positioned, but I don't think this changes the macro picture one iota.
Right, and the other news, which will be the news for the balance of the next, well, basically until the Fed meeting, was the beginnings of earnings season with the banks reporting strong numbers for Q4 and weak expectations and signaling recession for 2023, which, we're in this transition period where Q4 earnings probably will be in line to good, and Q1, 2 will be potentially where we start to see a turn, and we'll have to see as those earnings come out.
I very much agree. I think it was significant that JP Morgan in their call said that they are preparing themselves for a mild recession. I think that they are spot on. I think the other banks are doing much the same. And therefore, that probably reduces the probability that they will be badly hit, because if they're preparing their balance sheet and securing it for what could be a recession, then they won't get too badly hurt. But it still doesn't change the risk reward in chasing assets at these levels. Would you agree?
Yeah, I very much agree. Just one comment on the health of banks. It's just a very different cycle than we've seen in many, many decades, where the idea that the banks and a credit event is going to drive us into a stock market fall or whatever seems very unlikely relative to prior years. Yeah, as it relates to the range, we've been in a pretty narrow range in both bonds and stocks for quite some time, a couple of months at least. And just like any range, when it looks like that range may evaporate and, new highs in this case for bond prices and stock prices, there's quite a bit of, and you've seen it, quite a bit of grab anything type momentum in lots of things. We saw it in some meme stocks this week with Best Buy, a company that is almost certain to go bankrupt, rallying from $1 to $4. And certainly over the weekend, crypto's up 11% across the board. So there's definitely some FOMO going on. And the question is, will we break out? My expectation, given what we said about the Fed and the economy generally, is it's uncertain, and chasing makes no sense to me.
I would agree. I think there is quite a bit of cash on the sidelines. People probably were tactically too bearish, a few weeks back. It's the new year. People put money to work. That causes the market to rise. A bit of chasing, bad positioning gets unwound. But on a macro view, from all the data that we are seeing, the range might get slightly extended on the upside, but it's probably a better opportunity to sell rather than to buy.
Okay, so next week, there's actually some fairly significant news coming. The data's quiet, but the Bank of Japan has its meeting, and that might be a pivotal event. At the same time, we'll see a lot of earnings, and that will help us understand whether fourth quarter is, as we expect, fairly strong, and we're in transition to potentially weaker earnings. Nick, what do you think about Bank of Japan? Why is that important?
Well, it's important because there is a small possibility that they change their yield curve control policy, and they might shift it to fives, but they might unleash the tens. I don't think the probabilities are very high that they do it two meetings in a row. We had the surprise the last meeting. I think the odds are low that another surprise comes this meeting. But certainly, if they were to do it, the tens would probably jump something like 50 basis points to go to where the swaps are currently. And if the Japanese market goes 50 basis points, then the US market will certainly go 10 or 20 or 30 basis points. And that would compress the multiplier and also do no good to IEF or TLT. They would all back up. So you have this unlikeliness that TLT and IEF continue to do well next week, i.e. I would think that they are capped to the upside, and the probability that they come back is higher than the probability that they continue going up.
Yeah, and again, we can't assess the probability of such a change. I think it's inevitable. So whether they do it, and Kuroda is going to be gone by April, and the new appointed chair will be in place. So there's some pressure to do it in the next two meetings, which is this week's meeting and the following meeting. But we don't know. So it's worth preparing for such an event. But making a big bet on the outcome is again low odds. The one thing I would say is it is useful to look back to the first meeting, December 16th, to understand what markets did when the band was relaxed. And it was really quite a sell off globally. Now, there were a lot of other things going on, but it's worth paying attention to. So that's something we're very focused on.
And what do you think about earnings?
Yeah, so my big level of earnings is we've been in this great sweet spot where CPI has been top line revenue for companies, which measured by CPI has been very strong and now is flatlined with zero CPI. And yet wages, which are the input costs, are still rising and at levels like 6%. So that should put a squeeze on margin, but it's a recent phenomenon. So it's unclear whether it'll show up in the actual Q4 earnings, which I think is less likely, or in guidance in Q1 for Q2. But it's inevitable that tension will occur. It's just a question of timing. And so for me, I'm not making a big bet on what they say. I'm interested in ahead of time. I'm interested in what they do say and reacting accordingly. Yeah, so that's what we think about what happened last week, what's going to happen this coming week, and here's what we're going to do about it. Overall, we still think it's a market that rewards you very well with cash, and we don't plan on deploying any cash this week and believe in being conservative and balanced. But tactically, I think there's some things to do.
Yeah, I think given our view about the probabilities of what the market is going to do ahead of the Bank of Japan and then the Fed, where we still expect this 25 basis point hike, I think it's going to be wise to keep selling S&Ps at levels, i.e., when it reaches the upper band of what we expect the market to trade at, because even if you go 18 times earnings of 225, that's still 40-50 and we are there. So right. If we start going through that, I think it's a good opportunity to lighten up on equities. And if TLT starts rallying into the Fed, or IEF starts rallying into the Fed, I think it's a good idea to sell some calls against that. And I'll go into the precise levels in the next section where we do the order flow. So what happened to our portfolio last week? It performed pretty well. We've got an unrealized gain of about $4,200. We completed the purchase of 400 shares of IEF, and we completed the purchase of EWW, which is Mexico, which is the best performing market so far this year, 13.25% up. We're particularly pleased with XLY up 8.25%. So we are really not doing very much this week, but inputting some new orders, selling some calls in IEF and TLT, and continuing to try to sell SPY at levels, and I will show you those levels and why they're important now. In the pack that comes with each episode, you will see links to these charts so that you can play with them yourselves. I think the most important area is here between 108 and 112 in TLT. I think that is very unlikely to be broken in the short term. So we will be selling some 110 calls in TLT, and if the market wants them there, they can have them. How long will we be selling them for? I think the strike, as I said, needs to be 110, and also the expiry needs to be Jan 27th, which is the closest expiry to the Fed meeting. We don't want to carry that risk over the Fed meeting, therefore we're selling 110 calls in TLT to Jan 27th. And in IEF, the level that we are talking about is 101. Very unlikely to go through 101 until Jan the 27th, same expiry date. So here we have the live orders for next week. We have IEF, we're selling a 101 call. Disregard the level because I will be doing those basically at market when the market opens on Monday. We are selling TLT, 2 shares, 4 shares of IEF. Disregard this IEF here. This is an old order which wasn't filled. And SPY, we've moved the sell order to 412. for all 98 shares that we have. Thank you for listening to our third episode. We are new to this format and we would like to satisfy our viewers as much as possible. If you think we are waffling too much, if you think that we're not going into enough detail, please leave us some comments so we can rectify it for next time. You can leave it in the comments below, or you can send us an email from our website, Nick or Andy at twogreatbeers.com.